It's good going on the indices, about 0.8% higher on the Sensex and the Nifty and over 0.5%, that's 0.6% up on the mid-cap and the Nifty Bank. It's a healthy almost 3 in the green for 1 in the red kind of advanced declines ratio. Well, with that backdrop, let's examine the state of the economy after some of the big numbers that were announced over the past few days. The latest number, of course, has been the CPI inflation number. Sonal Varma, Managing Director and Chief India Economist at Nomura, and Sajjid Chinoy, the Chief India Economist at JPMorgan, join us now. Thank you very much, both of you. How impressed are you with the inflation numbers, Sonal? Can we expect a rate cut in February?
Impressed at the headline level, not very impressed at the core level. We don't think rate cuts coming in Feb. It is surprising because, the growth side indicators are now clearly pointing to a slowdown that is underway, and not just in India. I think globally, if you look at most indicator, export growth rate in a lot of countries has been negative in December. So the growth slowdown numbers seem to be there, despite cost side pressures coming off, the question is, why is core inflation so sticky? Because typically that's a sign of demand still being very strong. When we drill down into the numbers, it does seem like it's health and education categories which have driven core inflation. Even within health and education, it's more rural health and rural education that's driving. So it's not a broad base. Typically, if you're seeing a demands push inflation, you should see a broad-based inflationary pressures across all categories, and that's not the case. There are specific categories that are driving this. One suspicion we have is that clearly generic drug prices have gone higher because that's the category which has a higher weight in rural areas, and that potentially explains why health prices have gone up. We don't know the reason, but the point and the fact of the matter is that core inflation being elevated does not gel with the demand conditions and lower commodity price pressure. So our broader assessment is still that core inflation will come off, and the current persistently high core inflation we are seeing is a result of specific idiosyncratic factors and some lagged effect of past high prices pass-through still going on, but that's not going to be a sustainable scenario. Therefore, for February, we do think that there's still a decent probability of the RBI changing its stance back to neutral. Our base case view is that there will be a rate cut, but only in the third quarter of 2019, not immediately.
Okay, so no rate cut in Feb. Sajjid Chinoy also joins in. Sajjid, your view? You think the plunging inflation numbers opens the door for more monetary easing, or do you also belong in Sonal's camp?
I have a slightly different view, actually. I don't think growth is as weak as we think it is, and that's a view we've had now for several weeks. If you just look closely at the high-frequency data in India, the PMI surveys have held up at quite a high level. Bank credit growth has picked up very smartly and offset at least some, if not all, of the NBFC slowdown. The problem is, if you look at year-on-year numbers over the next few months, we'll get a very deceptive impression of the economy, because this was the same time last year that we had the post-GST restocking. Growth picked up very sharply. So IP is a classic case in point. You look at the year-on-year number last week and you feel, oh, growth's plunging. But if you look at the sequential momentum, actually, IP growth has picked up in the last 4 or 5 months. And for me, I take Sonal's caveats about this particular core inflation print being driven by health and education, but it's not this month alone. It's happened for 3 successive months now. 2 months ago, the momentum was 1% month on month. Last month, it was 0.5% month on month. This month, it's 0.8%. So for me, this is not so much of a surprise. We've always believed growth is not as weak as we think it is. Output gaps are closing fast. And therefore, for me, the fact that there is some pricing power is really not a surprise. Now, all of that said, the MPC focuses on headline inflation. That's been their mandate, and they've repeatedly said that they want to keep the inflation number close to 4%. The fact is, given the quantum and the breadth of the food disinflation, even accounting for core momentum being reasonably elevated the next 6 months, headline inflation, at least until September, August to September, looks like it's going to be below 4%. So if you're an MPC member going into this meeting, you've come into with two soft prints, the next 2 to 3 quarters look below 4%. My chances we certainly get a change of stance in February, and we get a rate cut either in February or April. The last thing I'll say is, because output gaps are closing, I think we should be careful here. What we don't want in 2019 is this inadvertent confluence of fiscal, monetary, and regulatory easing. That, for me, is a key risk.
Okay. Well, Sajjid, you know, actually you snatched away my next question. And I was going to ask you precisely that. While auto numbers were indicating weakness, when we spoke to the non-auto consumption guys, for instance, the paint guys, I spoke to KBS Anand of Asian Paints, I mean, quite clearly the biggest name, and he was extremely positive on the third quarter performance, on the festive sales. Just listen to him, Sonal, and I want your view as well on growth.
Since prices were rising, a 10% reduction made it definitely softer for the consumer. That helped. And it was coupled with a later Diwali, so that also helped. So overall, the current year seems to be a little better than the previous year, all said and done, so it's not bad.
Okay. Well, actually, if we were trying to get the bite where he said that they had a great festival season, actually, for Diwali season. So, Sonal, to you, it seems to be that the weakness is selective and that a larger part of the economy is growing well. So, you know, therefore, is growth, what are your growth numbers? And I think you said what you're expecting a rate cut in the third quarter. Is that calendar?
It's calendar, Lata. I think, you know, one is how are things here and now. And I do agree with Sajjid that the November IP numbers are exaggerating the underlying reality. So, you know, I completely agree on that. But in terms of, you know, when I look at the incremental growth drivers, the external sector situation at the margin has started to turn negative only in the last couple of months now. The data, you know, across the region is showing a synchronized slowdown in the export sector. Chinese data have been quite bad. The tech cycle is turning down. And to that extent, I think the Indian export numbers, you know, are also going to be weak. And there are links between the export cycle, the industrial production cycle, and the investment cycle. So I think we are potentially underestimating the impact that global demand will have into India going forward. Second, on the fiscal side, you know, there are clearly upside risks. But if the government is going to try to stick close to 3.3% of GDP, that does mean that incrementally the fiscal impulse is actually going to be negative going forward. And even if one accounts for off-balance sheet spending, the delta is definitely not positive. And third, while, you know, banks are stepping in, banks are not stepping in to give credit to all sectors. It's again, you know, largely the consumer side where retail lending is going up. So what happens to the SME and the MSME sector? What happens to the commercial real estate sector? I think those are specific sectors which are still, you know, credit constrained, and that will show up in the numbers in the coming months as well. So I think, you know, the situation as it stands today does suggest indeed that growth is all right. Maybe there is a bit of a slowdown, but it's not as bad as the headlines suggest. But I think if I look at the incremental growth drivers and what they suggest for the growth outlook over the next 9 months, they're all moving negative. What does it mean for the growth outlook? I think output gap has closed is essentially a statement of where things stand in the past. Going forward, our view is that growth will actually head towards 6.5% by mid-2019. Which means that output gap will actually start to widen again.
Okay, I wanted to take up the point you made about the fisc. You know, Sajjid, because do you think concerns around fiscal profligacy are increasing, as it generally does during election time, with all this talk about farm package, etc.? And do you think it will be hard for the government to sort of meet their fiscal glide path?
Two points. Good question. I think you know, we should separate this year's fiscal target. I think the government is very keen to stick to this year's target of 3.3%. I'm not sure, given what was budgeted, that we will have so much of an expenditure compression to get there. But even if we do, that's a 2-month phenomenon, really. The bigger worry is, I think, there is this gradual, I would argue, philosophical shift, and may well be warranted, that there is a lot of agrarian distress we've seen. The terms of trade have moved sharply against farmers, and I don't think we have the administrative capacity to, for example, push up MSPs or to push up market prices towards MSPs. So there's a growing clamor now across the board to actually have farm income support. The question is, how will that be paid for? I'm talking about the next fiscal year. If that is paid for theoretically by some transfer from the RBI surplus, for example, we should not conflate the deficit with the impulse, because the deficit will not change. That will be paid for by these transfers, but in fact the fiscal impulse will be very large. So I do worry about that. The second point I'll make is, if you step back, people focus so much or fixate on the centre's deficit. The real action has been in the states and off-balance sheet. If you add up centre, state, off-balance sheet and public sector enterprises, the consolidated deficit is 8.2% of GDP, exactly where it was 5 years ago. So we don't have much fiscal space. The last thing I'll say is I agree with Sonal on some of the global risks, but things have moved domestically as well. I'm not stating that there is no sectoral stress. There is SMEs and farmers. But the fact is, oil is today at 60 versus 80. That does provide a terms of trade, positive terms of trade impulse. You'll see margins go up, household purchasing power go up. And monetary conditions in India have eased meaningfully over the last 8-9 months. Bond yields are down 70 basis points now, and the trade-weighted currency has depreciated 8 or 9% this year. So I think there are some tailwinds for the economy going forward.
Date-wise, the budget comes first, and then comes the Monetary Policy Committee meeting. Therefore, you think there is a cut or no cut in February, or no cut at all, Sajjid?
No, we believe there will be one cut. I just think the headline numbers are too compelling for the MPC to ignore, since they focused on headline. I think in February, we certainly get a change of stance. Our base case is, it's just easier to go ahead and cut in February, barring there is no unpleasant surprise on the fiscal. So assuming on February 1st, the government sticks to 3.3 and next year's deficit is lower, 3.1, I think it just might be easier for the MPC to acknowledge the quantum of the undershoot in the last 4 months, cut rates once, and then buy themselves time over the next 3-4 months to figure out what's happening to growth, inflation, fiscal, and oil prices. So we have one cut in our forecast. Between Feb and April, it's a close call. Our base case is February. Okay,
well, actually, a final question to you, Sonal. Look at the way the MPC is positioned. We know that Mr. Dholakia has been dovish, and with the 2.19 last December reading, he is most likely to root for a cut. The new governor also sounded very dovish when he spoke to the press. The only time when he spoke, he said inflation and inflation outlook is benign. But who is the third vote? I mean, it does look like Mr. Patra and Viralacharya and Chetan Ghate are confirmed hawks. So, will he be able to push through the vote with Pamidua? Do you see that happening in February?
Yeah, Lata, I agree with you. I think the bar for a cut in Feb is a bit higher. I mean, directionally, yeah, we do think there'll be a cut. Bar higher for February, because when the MPC met in December, and including the minutes that were released later in December, by then it was very clear that inflation was going to undershoot. So the MPC, especially the other 5 members of the MPC, had a chance to give a signal if they wanted to actually indicate a cut at the next policy meeting, and none of that came through. So to move from calibrated tightening, which means there's no cut, to a cut in the next policy would essentially mean that the importance of communication via stance is irrelevant. So from purely a continuity perspective and sort of sequencing perspective, I do think it makes sense to change the stance, which brings us rate cut back onto the table, and then follow through with a rate cut. So yeah, I agree with you. I think the bar for a cut in Feb is high, but beyond Feb, there should be a cut.
Okay, just one final question from my end. I wanted, Sonal, your thoughts on the point that Sajjid was making about, the market borrowing from state governments having gone up, and that seems to be the big concern now. We're looking at some numbers. The net borrowing by state governments for this fiscal is estimated to be almost 14% higher than what it was last year, given that now they have a larger share of fiscal responsibilities, some, wayward rules with respect to farm loans, etc. What are your own numbers? What are you projecting? And do you think this is going to be the big concern as far as the fisc goes?
It is definitely a medium-term concern because, the fact is that there's been some amount of rollover of subsidies, delayed refunds, various ways to try to meet the deficit target at the center level year after year. And beyond center and states, clearly the issuance of government service bonds via various government companies has gone up. So when we look at the broader public sector, center, state and public sector companies and their total borrowing, that is quite high. And, we are in a macro situation right now where investment demand is still benign, is quite weak. In fact, I would say at a private level, where do we go if indeed private investment demand picks up in a big way? There'll be tremendous crowding out, and that itself can push up interest rates. So I think we need to combine this with the fact that a lot of medium-term fiscal commitments are being put in place now. They may not have an impact immediately, but in the medium term, they will add to more expenditure, while the GST side revenues have continued to disappoint. So I do think medium term there are fiscal concerns, and we need to tackle that quickly, even though near term, the deficit is being managed.
All right. Sonal, Sajjid, out of time. Thank you very much for joining us. So point taken, inflation benign, but crowding out will keep the cost of money higher.
Okay, well, the market is quite interesting. It's really Infosys and Reliance which are helping the bulls right now. The mid-cap index is also a bit soft compared to the overall market, and the Bank Nifty is also struggling at higher level, though Yes Bank, of course, up about 4.5%. Ashwani Gujral, Mitesh Thakkar back with us. Rajat Bose is also here. Good morning again. Ashwani, are you running that short you took in the opening trade, or have you reversed that call? What's the index call now, and what about individual stocks?
See, the point is that 10,770 has held on. So, in a sense, the Nifty this time is outperforming. But if, financials start to give up ground, then, you could probably neutralize financials with the Nifty. So, I'm just hoping that, in case we are able to get to about 10,900, Bank Nifty can probably limp along. So, that way, probably it's a good idea to start taking long positions on Bank Nifty and keep a 27,400 type stop, because the rally has just started today. Unlikely that today itself it's all over and we start ignoring global cues. But it should be clear that it does not look like the Bank Nifty outperforming. So in terms of profit booking, etc., you have to keep this in mind. But PSU banks are coming down. In fact, private banks are holding up. So that is the only hope here. And let's see if we can get past 10,900, 950. Reliance is a big positive, and chances are it can prevent the Nifty from showing downside volatility. Having said that, individual stocks, Yes Bank is a buy with a stop of 196, target of 211. RIL is a buy with a stop of 1100, target of 1160. And HDFC Bank is a buy with a stop of 2100, target of 2145.
Okay. Thanks for that, Ashwini. Mitesh, good morning again. What are your 10 a.m. trades?
So I also have Reliance on my buy list. It's a buy with a stop at 1105 for targets of 1140. And Pidilite is something which where the intraday charts are quite positive. So keep a stop at 1135, look for targets of 1170. I think it's moved up slightly, but around 1146, 47 would be a good entry.
Okay, and Rajat Bose is also joining in. So let's get him on board. Rajat, hi, good morning. What are the stocks on your radar this morning?
one IT and one auto stock. Tata LXI January futures, I would like to buy with a stop below 959. It's a positional trade. 1016 and 1043 are the two targets. And Maruti January futures, 7395 is my stop loss. 7548 and 7655 are the two targets for Maruti. Both are looking pretty good after yesterday's trade.
All right, gentlemen, thank you very much for joining us with your 10 a.m. trades. The market's in a fine spot for the bulls, but we'll have to see whether they'll be able to hold the initiative and even build on it.